Afternoon, everybody. Apologies that we're a little bit late. We've had some technical issues with some people getting in. Hope everybody's enjoying the sunshine as much as you can. Clearly, we are in a new phase as we start to come out much more of an easing of lockdown. Clearly, there's been some hotspots and some local lockdowns and some other bits and pieces, but hopefully today we can give you a rundown of where we believe we are and where we're going in terms of the new normal. So without ado, we'll start, and I will hand over to Stephanie.
Thank you, Greg. I'm going to talk about annualised hours. Annualised hours are traditionally used in industries where demand varies seasonally. They remove the situation where employers are required to pay employees on fixed hours of work for their full hours, even when they're not working to their maximum capacity during quieter times, and then conversely, incurring overtime costs or needing to employ temporary staff during busy periods. Due to the uncertainty about levels of work, as we slowly return to the new normal post-lockdown, employers may wish to introduce annualised hours to make the most of their workforce, maximise productivity and protect jobs. So, how do annualised hours work? Under an annualised hours contract, the employee's working hours are expressed as the total number of hours to be worked over the year. This allows for flexible working patterns during the year to help employees meet peaks in demand for their products or services and maintain continuity of production. The number of hours to be worked is calculated by taking the total number of possible contracted hours for a year, based on the normal weekly number of working hours, and taking into account the number of hours equating to annual holiday entitlements and public holidays. These hours are then worked across the year according to the needs of the business, rather than a regular number of hours each week, subject to working time legislation, of course. This is useful for employers who are going to have fluctuating demands for their products and services. It enables them to require staff to work more hours when they need to increase production levels and not to have them at work when they do not. Normally, a number of regular hours will form the core of the arrangement, with the remaining hours left unallocated to be used on an as-needed basis. Actual hours worked must be recorded and should be reviewed on a quarterly basis to ensure that employees have not worked over or under their hours by the end of the year. While employers can agree to pay employees for the hours actually worked each month, in many cases, employers make salary payments in 12 equal monthly instalments. This provides a regular income, which makes annualised hours contracts more attractive to employees. However, it does mean that the employer will then need to calculate the hours worked and amounts paid if an employee leaves during the year. The total number of hours will take into account annual leave entitlement, so employees should be able to request and take paid holiday in the same way as employees who work under conventional contracts. Employees who are paid in equal instalments will continue to be paid as normal when taking holiday. Employees who are paid for hours worked each month should be paid their normal rate of pay during periods designated as annual leave. SSP is only payable on qualifying days, which are days on which the employee would otherwise have worked. Therefore, employees will only be entitled to SSP for days on which regular hours would have been worked or on which additional hours had been given. And although there may be periods during the year when employees will not be working, the continuity of service will not be broken as the contract remains in place, and entitlements such as pensions and holidays also continue. Employers would need to accurately estimate workloads and working times to avoid running out of hours, and also need to have a procedure in place for notifying employees of when they're required to work additional hours. They'll need to manage the use of regular and additional hours carefully. Failure to do so could result in employees not working their full annual hours, and if they're being paid in equal instalments, this is likely to result in their being overpaid. The employer would then be in the situation of writing off the lost hours, which is likely to lead to resentment from employees who have worked their full complement, recovering the overpayment via deduction from wages, which is also likely to cause resentment if the overpayment has resulted from the employer's failure to manage the hours properly, or requiring employees to make up their unworked hours during the next year. None of these are ideal scenarios. To do this, therefore, employers need to monitor and record their additional hours process carefully to ensure that hours are evenly distributed. If employees work more than their annual hours total, because more additional hours have been worked at the employer's request, the employer needs to have agreed whether these will be paid at normal rate, an overtime rate, or be carried forward into the following year. And this would depend on the reason why the additional hours were required, and it may also then lead to a review of the number of regular hours that need to be included in the annual hours total. A successful annualised hours system therefore depends on good design. It can also only be introduced following consultation with employees and after adequate time has been given to prepare for its introduction. As overtime is being removed and consolidated into basic pay, employers who currently enjoy overtime earnings would be disadvantaged. So employers may consider making a one-off payment to compensate them for this future loss of overtime. As employees may be required to work extra hours at short notice, this may disrupt their planned leisure time. They may also be expected to work longer hours seasonally, including during the summer. These considerations must all be taken into account when seeking to introduce annualised hours. Therefore, whilst annualised hours are potentially a useful way of maximising workforces in difficult times such as this, there's also a lot to consider before going ahead with implementing them. Thank you. I shall hand you back to Greg.
Thank you, Stacey. That was brilliant. We'll now hand over to Nigel Morris, who will talk to us about Furlough Scheme and the likes. Nigel, fire away.
Hi there, Greg. Thank you. Sorry, a few technical issues. So yes, thanks very much. So just to touch on the Furlough Scheme. So this has been some pretty vital support for all businesses now. And as of the latest statistics, has supported up to 9.5 million employees and nearly £34 billion. So it's well on track to reach the £50 billion mark by the end of October. But it is ending. And I think we all know that it's been a fairly complex scheme, although phenomenal support. But there's been lots of changes to the phase one, and now now we've got more complexity even around the flexible furlough. So we've seen lots of misunderstandings and errors by businesses, and I suppose the short message is make sure that you review your furlough claims that you've put in, put things right. There's still an opportunity to do that. And make sure that you've got the agreements and the calculations in place, because it's a real likelihood that despite the advantage of this arrangement and how good it's been, HMRC will be clawing money back and undertaking reviews, and that will include interest and penalties, just in the normal course of affairs in relation to employment taxes. So there are some special penalties that will apply to fraud, but even for simple errors and mistakes, you need to look at putting things right. I think what the coronavirus job retention scheme has helped, and the furlough scheme has helped people to understand, is actually that work can be done remotely, and there have been lots of employees that have been working from home, even if they haven't been furloughed. And I think the advice in relation to that is obviously look at what allowances you can claim. HMRC have introduced a relaxation to working from home allowances. So normally it's quite a high bar to be able to claim these and to justify that you need to work from home, and it's wholly necessarily and exclusively in the performance of business rather than just for convenience. But they've accepted that during COVID-19, you can claim a fixed amount of £4 per week up to the 5th of April and £6 a week from the 6th of April if you've been required to work at home. Or you can claim the actual costs if you can produce bills with a breakdown of the actual additional costs, such as a phone bill. That's pretty difficult these days to get itemised bills to justify that, but certainly these flat allowances are out there where working at home due to COVID-19 has been a requirement for people to keep working and to keep businesses going. So that's good news, but that easement will be removed at some point when people are getting back to work normally. What that normal looks like in the future could be very different. So businesses need to think very carefully about their working from home or their flexible working policies, because the next normal is going to look quite different from the past. Clearly, if you work in a retail store, you kind of need to be there. But if you work in the head office, then maybe you don't need to be in the head office, and there's more flexibility around working from home going forward. We've seen lots of agile working take place, and we know that in those circumstances, and for ourselves at McIntyre Hudson, that the workplace will probably never be the same again. But that's something we can embrace, and therefore how businesses need to think about how they do embrace that agile working, whether current policies, procedures and terms and conditions are actually fit for that purpose. There is a potential chance that we'll get a second wave or even more local lockdowns. So, you know, how is that planned for? Have we got plans in place to deal with that? And what can we learn from the first phase in relation to how to deal with another wave or local lockdowns? Have we got those plans that are there ready for us to easily execute, and that we can continue to cope with trading through any second wave or local lockdown? So maybe, you know, what have we learned and what can we put in place to make things better? And obviously finances have been hit. You know, there's been issues despite the coronavirus job retention scheme that's been massive support. So when's a good time? You know, have we already taken time to reflect on remuneration packages and terms and conditions, just to make sure that we can be as flexible as possible in the future, that we've got those clauses in place that give us the agility on how to pay people and when to pay people, what expenses and benefits are actually going to be fit for purpose in the next normal. Because maybe, you know, the traditional basis and the traditional T's and C's won't be up to it and won't give us that flexibility in our financing. And then just finally, I suppose, because you know, as we have the potential to sort of you know, ride this through for quite some time, and probably, you know, relevant to some of the funding that Greg's perhaps going to cover. You know, how at risk is the current bank balance and balance sheet? To say, you know, HMRC undertaking a review of the furlough claims, finding errors and mistakes, and clawing back, you know, and how agile and how fit is the business if HMRC would suddenly come back, you know, in a few months' time, you know, or 6 months or 12 months or 2 years, and try and claw back 25% or 50% or even 100% of your furlough claim. So things might look good now, but you know, how safe is that, and how reliant can we be on that to you know, to satisfy funders and to make sure that any threat from HMRC has been covered off. So just some things to kind of think about there as we move forward, you know, and thinking about the focus of you know, back to business, the next normal, and yeah, what's you know, preparing for the future. So yeah, so thanks, and I'll hand over to Greg now.
Thanks, Nigel. That was brilliant. So let me just share my screen. I'm going to attempt to use some slides. So what could possibly go wrong? Hopefully you can all see those. And let's get that one up. There we go. So my name's Greg Taylor. I'm a partner at McIntyre Hudson and head of MHA Financial Solutions. More than 4 months after the start of the lockdown, it is the SME sector which is under the most intense pressure and where companies are being forced to take a long look at their finances. Close to 6 million businesses employ more than 60 million people in the UK and generate 2.2 trillion in turnover last year. But many are increasingly desperate as the pandemic has continued. Slow sales growth has been seen in many sectors, not all, but many, across the UK, which in turn has been sucking dry SMEs' limited cash revenues. Even with the easing of the lockdown, UK Finance, which represents the banking sector, found that a fifth of small firms had less than 1 month cash reserves left in May. A quarter of owners had been forced to use their savings to stay solvent, which may explain some of the low take-up on the coronavirus business interruption loan scheme, which we'll come to in a minute, while almost a fifth say that they were likely to cease trading or may not survive. In my view, the government did act decisively in trying to shore up the sector with tens of billions of guaranteed loans, grants and business reliefs, even though some of the loan schemes have had their issues. coming on top of a broader array of business support, such as Nigel discussed the furlough scheme. But have these measures gone far enough? At 3:30 a.m. on Monday morning on the 23rd of March, British Business Bank received the final term sheet for the emergency loan scheme designed to rescue thousands of small businesses fast running out of money. The agreement came just hours before the scheme went live that morning. Rishi Sunak had promised, the Chancellor had promised to do whatever it takes to secure the future of British businesses that had shut their doors as the UK entered the coronavirus lockdown. Thousands of businesses would disappear without government support and millions of livelihoods were at stake. The government had pledged 330 billion in guaranteed loans for the business sector, offered interest-free for the first 12 months, plus an 80% government guarantee. The Bank of England would also then step in with a 150 billion term funding scheme for banks that came with additional incentives for SME. This was followed by further schemes, the CBILS for larger businesses on the 27th of April, which were loans up to initially 50 million, later extended to 200 million, although with strings attached. And then the Bounce Back Loan Scheme, or BBLS, to support smaller businesses and those requiring loans between 2 and 50,000 at a low fixed rate of interest at 2.5% per annum. That came on the 4th of May. The number of loans by banks for SMEs in the second quarter was 14 times higher than the average quarterly total of loans and overdrafts provided to SMEs in previous years. So the schemes here now have had a number of different changes. So the coronavirus business interruption loan scheme has been changed on 4 separate occasions. The larger scheme on 2 separate occasions, and the bounce back scheme just the once. The initial much larger scheme, the COVID corporate financing facility, in the end, there was only roughly, from our calculations, 30 to 100 businesses that had the short-term investment grade that could meet the qualification. There are now 26 lenders on the bounce back scheme from an initial just 5. There are 22 lenders on the larger business scheme, and there are over 90 lenders, including challenger banks and fintechs, on the coronavirus business interruption loan scheme, the original scheme for loans up to £5 million. So the stats straight off the press for the second, which came out this morning for the 2nd of August, and you can see if you look down the schemes that the top scheme there is running at just below 50% and has been for a long time. The larger scheme is running just over 50% and again has been for a long time in terms of success to application. And the smaller scheme, the BBLS, is running at around an 84% take up and again has been, although according to figures that I've seen, they reckon around 40% of those loans on the BBLS will not be recoverable. Or were taken fraudulently. So again, they have had their problems. The process hasn't been great, but they have been a lifeline for many businesses. So what is the future of CBILS? The potential withdrawal of the loan schemes with no replacement will not only leave UK SMEs without financial assistance, but saddled with interest payments for many years to come, creating zombie companies and hampering future growth. The extent of debt on balance sheets of some SMEs will be a big threat to the recovery, according to banks and business lenders. Some businesses had entered the pandemic with debt more than twice matched by cash and deposits, according again to UK Finance. 60% of small UK firms had 5,000 or less in credit balances by the end of 2019. The City UK is calling for an extensive package of support, further support, by converting and extending the debt. It estimates that they will need to be up to 100 billion of government-backed debt taken by small businesses to survive the pandemic, of which 34 billion will become unsustainable. Other economists have argued that the government will need to convert some of the debt into equity stakes to support businesses through the coronavirus, or create a bad bank to hold debt that cannot be repaid. Rishi Sunak dampened expectations this month by saying that businesses should not expect another bailout. Nevertheless, officials are acutely aware of the problems, and proposals, according to those close to the Treasury, are taking place with the large banks. John Glenn, the Economic Secretary to the Treasury, in a recent interview with a fintech lender, said that there were no plans at the moment to extend the CBILS scheme. So other alternatives could be to return to the old EFG, the Enterprise Finance Guarantee Scheme, on which the CBILS is based, with maybe some tweaks. There is no doubt, or even perhaps, we've heard mention of the fact that there may even be some sort of student loan taxable on a percentage of profit within industry sector normal margins. So there are plenty of options. What's for certain, I think, is that the schemes will not continue in their current guise. If we work back from the furlough scheme announcement, roughly 6 weeks before the scheme ended, we should know sometime week commencing the 17th of August what the plans are for CBILS. So if the schemes are not continuing, then what happens now? You have until the end of September if you want to put your CBILS scheme application in, October for the larger business scheme, and the 4th of November for a bounce back loan. One of the changes that came into the CBILS scheme at the end of July was the change with the European state rules around business in difficulty. Business in difficulty is a company that finds itself in any of the following circumstances: a limited company less than 3 years old, or within 7 years of its first sale, with accumulated losses of more than half of its share capital. Company without limited liability, meeting the criteria outlined above with accumulated losses of more than half its capital. Company that is subject to insolvency proceedings. A company is in the process of repaying rescue aid or is subject to a debt rescue plan. These criteria meant that early stage companies and scale-ups and those backed by private equity didn't qualify for funding because they prioritise growth over profits. Some claimed the higher failure rate associated with these business models should deny them access to funding. Others argued that it was not only unfair, but it was also unwise to exclude what were typically innovative companies after all. They create jobs. They drive the kind of growth required to recover from an economic slowdown. If you fall into this sector or have a business that just had a poor 2019 for whatever reason and have been rejected for a CBILS previously, then you may now qualify for the scheme, so please get in touch. Finally, I'm going to end with my top 3 tips for not being rejected on CBILS. Avoid errors on CBILS forms. Delays due to errors on applications can be the difference between business survival and getting the loan quickly or waiting weeks or even being rejected. According to government figures, there are approximately 60,000 backlog of CBILS loans. If you want to get to the top and get your money quickly, make sure there are no errors. That's why using an advisor, such as MHAFS, you are 30 times more likely, according to NatFab, to be successful than if you approach a lender directly. Forecasting is crucial. Under the CBILS criteria, lenders shouldn't look forward on a firm's prospects anymore, but banks find it hard to depart from traditional banking principles, and many applicants just aren't including forecasts, or in some cases, full forecasts, a P&L, a balance sheet, and a cash flow. Explain how you will operate in the new normal. An essential element is to explain how the business will move forward in the so-called new normal. Social distancing restrictions have changed the year's outlook for the vast majority of firms, whether they are listed entities or SMEs. The 3 CBILS schemes won't continue. They will be replaced with something or a combination of initiatives. Commercial funding to SMEs would fall off a cliff, I believe, without some form of government support or intervention. Therefore, with the schemes due to end in their current guise, If you believe your business requires government funding support, then please get in contact. Hopefully that was useful, guys. And as I said, if you want to talk to me, then please find me and get hold of me. And I will hand over to Lawrence, who will talk through some other funding options.
Greg, yeah, I'd now like to spend some time giving you a flavour of some of the key factors that you need to be thinking about if you're considering raising equity finance into your company rather than debt. And so this is very much a topical. So if I could just start with some of the key considerations that you need to be thinking about. First one, secured risk that they're taking. Over the lifetime of their investment, this return can be anything between 2.5 to 3.5 times their initial investment, which can invariably equate to something between a 25 to 30% return per annum, which is clearly much higher than the cost of secured debt. Another factor to consider are the current debt levels in your business. Existing financial covenants may restrict you raising more debt. Greg's already spoken a little bit about businesses with lots of debt already. So equity may actually be the only viable route for you if you need an injection of cash. Growth profiles are important for equity investors. Businesses with higher growth prospects are far more attractive to them as they offer the best chance of the high returns that I mentioned a few moments ago. Future exit options also need to be considered. Equity investors ultimately want to realise their investment, so there needs at the outset to be an alignment of thinking with you as the existing shareholders on the exit strategy and the timings of that. The duration of the funding is also important. Equity is generally a longer term funding source than debt, and may therefore suit some business owners who have longer term growth and investment plans for their business. Asset profiles also important. Businesses with less robust tangible asset bases will lend themselves far more rate equity than debt, and all dividends can be held if needed, whereas interest and capital repayments on debt invariably can't without breaching financial covenants. You should also be thinking about operational and strategic support. Some owners welcome the expertise that an external, highly experienced equity investor can bring to their business over and above the funding. Also, control. Equity investors will want to protect their investment, and they do this by the use of mechanisms like enhanced voting rights, ratchets, good and bad leaver provisions, and tag-along conditions. And I'm getting a message that the bandwidth on my Wi-Fi isn't great, so I'm going to try and sort that out and come back and finish off this part of my presentation in a moment or two. So I will hand over to Jay at the moment to talk through some other stuff on R&D with you. Hopefully Jay can hear me, and I will come back in a moment or two after Jay's finished to try and finish off my presentation when I've sorted out the Wi-Fi problem that I'm having. Okay, thank you.
Thanks, Lawrence. Yeah, I'll pass back on to you. Just let me know when you're ready. And first of all, good afternoon, everyone. Thank you for joining us. As you may have been following the series of webinars that we've been doing on COVID-19 and business continuity, we've talked about R&D claims quite a bit before, but just as a quick refresher for those who might not be familiar, the R&D scheme is 20 years old this year. It's essentially a tax incentive that all developed countries offer to their companies that operate there as basically as a reward for investing in people and conducting good scientific or technological work. The title R&D tends to throw people. I always tend to replace it with problem solving. If you think that you're eligible for an R&D claim, it's useful to think of it in problem solving terms. Was I solving any problem using software technologies and enhancing it, or food or engineering? The scope is very wide. So the legislation has purposely been made open-ended, so it's open to interpretation. And essentially the other aspects we've covered is, so you have your R&D claims, then the R&D claim is split into two. You've got your SME scheme. So if you're a company that has less than 500 full-time employees, 100 million euros in turnover, or 86 million euros in balance sheet assets, then you're considered an SME, and you can claim in the more generous scheme where you could get anything from 25 to 33% back on the costs that you incurred in trying to do that work. Alternatively, if you don't fall into that category, you can claim in the large company scheme, which is called R&D expenditure credit, and the benefit there is approximately 10%. So you get 10p for every pound that you claim. Then we discussed essentially what the rules are around. I'm really sorry about this. I have ice cream trucks patrolling the area. So the other aspect we discussed was, well, the SME scheme is considered state aid. So what we mean by that is, if you've had a grant, like let's say from Innovation UK or from the EU, that is also considered state aid. So you can't have a grant subsidizing work and then add R&D on top of that, because that's unfair. Basically, you have two forms of state aid subsidizing the same piece of work. In that scenario, you would have to claim that project that you did in the less generous RDEC scheme. And then we covered what are the effects of essentially the coronavirus business support schemes, as Greg and has pointed out earlier. CBILS and bounce back loans, well, especially bounce back loans, have been popular. So the issue there is that's also considered state aid, and if you take that and subsidize any bit of your work that related to R&D, you would have to put that into the RDEC scheme. So we've established that in previous webinars. Now, as a recent update, we sit on HMRC's R&D Consultive Committee, which is basically a panel where we give feedback to HMRC on R&D claims. They talk to us as well on what they're seeing coming through. And the major theme that's coming through really is that HMRC is reiterating that anyone who is providing R&D tax credit advice is tax advice. I know how obvious that sounds, but it's very important, because what they've noticed is a lot of companies, since the R&D tax schemes have matured, what's happened is there's almost a split that's happened in the industry. You've got some very good mature players, but at the same time, you've got quite a few boutiques and sole contractors as well who are offering that service. And some of them may not be in practice, like McIntyre Hudson. The issue with that is, well, in McIntyre Hudson, we're regulated by the authorities to basically follow best practice guidelines and give proper tax advice. A lot of these boutiques are not bound by those rules. So one of the aspects that a lot of practice firms follow is the professional conduct in relation to taxation, or the PCRT. HMRC has reiterated that the PCRT must be followed in relation to R&D claims. Basically what the PCRT does is it tells people who practice tax that there's certain regulatory expectations of objectivity, impartiality, professionalism that have to be observed, and integrity. Again, just to reiterate, all of these things sound quite obvious, but the problem is, I guess what HMRC was gently trying to hint at was, be careful of people saying, yeah, you definitely have an R&D claim. We can get you 100% guarantee that we can get you the claim done. HMRC don't release their inquiry figures, so there is no public information of actually how many investigations they open in R&D claims. So if you come across that, just view that with a bit of skepticism. Good indicators of R&D advice is where the claim is scoped out, the potential for eligibility is established quite early on, and that is explored through a detailed review. And R&D is essentially the DNA of your business. It's looking at the marriage between the technical problem-solving activities and the financial costs incurred. So really, it's a marriage between the management, the technical, and the financial departments together. All these three need to come together. So HMRC have said they've observed multiple claims come through where, a finance team has put something through without talking to the technical team in the worst case scenario, or the opposite, a technical team have cobbled a claim together and it's not really been reviewed properly from a tax perspective. Because remember, your R&D claims are joint onto the tax computation. The other aspect that HMRC mentioned was the fact that there were quite a few updates talking about what's going to happen in the future with R&D claims. But I can summarize all of those to basically say, watch out for the autumn budget. That's what HMRC was saying. We're going to watch out for that budget as well and examine how the rules change. One of the major considerations there are obviously the state aid rules. So the state aid rules have been established by the EU originally. As we have left the EU and we're in the transition period, whether this will be negotiated or we'll pretty much decide whether we want to follow our own regime, it's all a big question mark at the moment. But yeah, we are watching out for the autumn budget for some kind of announcement. But it's important to remember for any R&D claims that you might be doing for that cover the period. So R&D claims are retrospective. Remember, they cover your latest tax period. If you've had, first of all, employees under furlough, just make sure you don't do the schoolboy error of making a claim for staff time when they were on furlough. That's something that HMRC will capture quite easily. And also make sure that you have some kind of a record to show how you spent any CBILS or BBL funds. And the only other aspect that came out of the advice from HMRC was the SME scheme is really lucrative because it benefits loss-making companies, so startups, etc. They have massive losses. They might not have that much staff, but then it allows them to basically enhance these losses and then surrender them for cash. Unfortunately, we had a few unscrupulous companies in the UK who tried taking advantage of that. HMRC have locked down on them. However, one of the measures that HMRC tried to bring in was a cap on the cash that the company can get back. And the cap was initially designed to be 3 times the payee and NIC contributions the company has made in the year. Obviously, that benefits in preventing fraud. However, it unfairly targets startups. As I mentioned, they don't have much staff. So we fed this back to HMRC. They've suspended the cap for now until the 1st of April next year. And we've given them feedback on how to make this cap a bit more tailored to the startup UK market. And not just startups, you could just be a small company that, has very small payroll costs. So we're actively talking to HMRC to bring in a more realistic and more fairer measure of identifying real companies that are doing R&D claims. So that's my quick update. So just very quickly, PCRT, you can Google it. Just type in PCRT, CIOT, R&D, and it'll come up on HMRC's website. It's just guidelines. It's really useful for you to have that if you're making an R&D claim or thinking about it, because it sets the foundation for the type of behaviors that any advisor is supposed to follow. And yeah, watch the space. We're actively talking to HMRC, and we hope to give you some new updates on any changes to state rules or any considerations to R&D claims and expenditure coming through. I think Lawrence might be okay now. Lawrence, are you okay to take over?
Hi, Jay. Yeah, hopefully people can hear me now a little bit better.
Sure.
If not, if someone could message me, we'll obviously stop again.
Okay. Okay. Thank you.
I'll try to now just finish off on the equity investment matters. Ran through the major key considerations to look at when raising equity funding before I stopped and let Jay carry on. I think also what you need to be considering, apart from those considerations, is what else can an equity investor offer you? And here are some of the key questions that we suggest that you ask. The first one is, what strategic and operational support can they provide to your business on an ongoing basis, and at what cost? Also, what access do they have to a wider network of contacts in your existing and or your target markets? What access do they have to outside personnel who may be able to supplement the incumbent management teams and shareholders' expertise to help grow the business? What channels exist to meet with their other portfolio companies so that you can tap into sales opportunities with those businesses and also share best practice? Another couple of things, what further funding do they have available for you to grow your business via mergers and acquisitions or other growth opportunities that you might come across? And also in terms of working capital, capital equipment, new premises, etc. And finally, what's their preferred exit timetable? Does that tie in with yours? If you decide that equity is the route that you want to take, then one thing that you will need is an investment document. This document sells the business to investors, details the business's unique selling points, and will outline midterm growth plans and your longer-term strategic objectives. There are a number of things to consider in such a document. I'd be happy to discuss these further offline with anyone who wants to get in touch with us. But just to give you a snapshot, some of the things that you'd need to be considering, you'd need to put in some history and background of your business, the products and services, and where appropriate, any production methods that you have, the market and the demand for your services and products, both now and even more importantly in the future, an analysis of your key customers and suppliers and competitors, an assessment of any barriers to entry for prospective new entrants, also a marketing plan, details of your intellectual property rights and management information systems. Very importantly, details of the management team, as these really are the people critical to realising the plan in terms of the view of equity investors. Details of your facilities and premises and ability to expand those in the future if your business grows. Financial projections, your P&L, your balance sheet, your cash flows, the amount that you require and what the proposed use of those funds will be. And as already said, exit options and timescales. And also don't be afraid to factor in some of the risks inherent in the business. Don't avoid talking about them in the document. By putting them in there and actually identifying ways of minimizing those risks, you're actually showing equity investors that you can identify that there are risks in your business as well. So if on the basis of all that you get a deal agreed with a preferred equity investor, then due diligence and detailed transaction documents follow. But for the purposes of this webinar, that's the end of my summary for now of equity finance considerations. Thanks for your time. I think it's back over to Nigel, is it now, or Greg?
It's myself. Thanks, Lawrence. Hi, everybody. So, yes, apologies for the technical issues we've had today. Technology is great when it works. But hopefully everybody's been able to take away something from today. It's been useful for you, and I'm sure as things evolve, all of us will come back and do another one when we've got more information to pass on to you to help you run your businesses, which is clearly what we're here to do, is to support you guys as much as we can. And without further ado, we will let you get on with your afternoons. Speak to you all soon. Bye-bye.